Thinking of buying a home in 2026? Stop scrolling right now. The rules of the game just changed overnight and nobody is talking about it. The era of buy now, get rich later is officially dead and buried. And what the big banks are whispering behind closed doors is terrifying. It might just save your entire life savings from disappearing into thin air. We're talking zero growth, trapped homeowners, and a lending freeze that's leaving buyers out in the cold. If you don't know the new rules, you are walking into a financial buzzsaw. What is up, everyone? It's your boy Bunny Bucks back on the block. I'm out on the streets today, not sitting in some stuffy, air-conditioned corporate office. Because we need to talk about what is actually happening on the ground level. I've been grilling loan officers and interrogating real estate agents all week. I've been looking at the for sale signs piling up in neighborhoods just like this one. And I've got to tell you, fam, the vibe has completely shifted. For the last 10 years, we had this mindset. Just get into a house. It's a money printer. Well, welcome to the harsh reality of 2026. The printer is jammed. We are seeing a massive standoff between buyers who are broke and sellers who are delusional. But the biggest player in this game isn't the buyer or the seller, it's the bank. And today, I'm going to give you the banker's brutal truth that they won't put in the brochures. I'm taking off the YouTuber hat and putting on the banker hat to show you the internal numbers. We are going behind the vault door to see why the market hasn't crashed, but it hasn't recovered either. We're breaking this down. The zero growth reality, the rate trap, crashing regions, and the new secret lending rules. If you appreciate honest money talk without the corporate fluff, do me a huge favor. Smash that like button. It helps Bunny Bucks get the truth out to the people. Now, let's hit the pavement. All right, part one. Let's talk about appreciation, or rather, the total lack of it. You see this house? In 2021, this thing would have had 10 offers in 24 hours. It would have sold for 50 grand over asking price, no questions asked. Today, it's been sitting here for 45 days, and the only visitor is the mailman. Here is the brutal truth. J.P. Morgan dropped a bombshell forecast for 2026. They are projecting roughly 0% national home price growth. Zero, a big fat goose egg. Think about what that actually means for your wallet. This changes the math completely. For a decade, that 5% or 10% growth was your safety net. If you lost your job, you could sell, pay the fees, and walk away with cash. But now? Let's say you buy a house today for $500,000. Next year, it's still worth $500,000, or maybe even $495,000. You are actually losing money. You have to pay 6% to sell that house. You paid closing costs, property taxes, maintenance, and interest. That money is gone. Redfin is backing this up too, predicting maybe 1% growth. That is basically inflation-adjusted losses. We are looking at a market that has hit a hard ceiling. Buyers have maxed out. They physically cannot pay a penny more. The well is dry. So the banker's truth is simple. A home in 2026 is a place to sleep. It is strictly shelter. It is absolutely not an investment vehicle anymore. If you buy thinking you'll flip it in 2028 for a profit, you are gambling. The banks know this. That's why they are nervous about lending you the full amount. They know if they foreclose, they won't make a profit on the resale. This flat market changes the math on everything you thought you knew. Renting suddenly doesn't look like throwing money away if owning costs you more. Now let's move to part two, the interest rate trap. This is the killer. We all keep waiting for the Federal Reserve to save us. Rates will come down, they say. But let's look at the numbers. Realtor.com and CBS News are clear. The 30-year fixed mortgage rate is hanging tough right around that 6.3% mark. Listen to me, 3% is gone. It was a unicorn. It was a glitch in the matrix. It was a once-in-a-lifetime event. It is not coming back. The problem in 2026 is what we call the spread. This is destroying volume. Mortgages are tied to the 10-year Treasury yield plus a risk premium. Investors are nervous about inflation, so they demand a higher return to lend to you. You have millions of homeowners sitting on 3% mortgages. They are locked in. Why would they sell to buy a new house and literally double their monthly payment? This creates a frozen market. Inventory is stuck in the deep freeze. The only houses for sale are from the 3 Ds: death, divorce, or desperation. But for you, the buyer, paying 6.3% in a flat market is pure pain. Let's run the math. I want you to see exactly where your money goes. On a $400,000 loan, the difference between the old rates and today is staggering. It's about an $800 difference every single month. That is $800 of pure interest going straight to the bank, not to your equity. Over 30 years, that is hundreds of thousands of dollars wasted. The banker's truth regarding rates is a double-edged sword. Banks love the higher yield, but they are absolutely terrified of the default risk. When rates are this high, your monthly payment eats a huge chunk of your income. One flat tire, one medical bill, and you might miss a payment. That is why getting approved right now feels like a police interrogation. They are realizing that at 6.3%, most American families are one bad week away from disaster. Part 3. Location, stagnation, or maybe even crash nation. While the national average is flat, some places are actually bleeding red. Remember the Zoom boom? Everyone moving to Texas, Florida, and Arizona? Well, that party has a massive hangover. The music stopped. JP Morgan and Redfin have specifically pointed out oversupplied markets in the Sun Belt. I'm talking Austin, Phoenix, Boise, parts of Florida. Builders went crazy there. They built thousands of units expecting migration to never end. But it did end. Now you drive through and see inventory piling up. If you are in these markets, 0% growth is a fantasy. You're looking at drops. This is dangerous for one specific reason: being underwater. If you put 5% down in Phoenix today, and the market drops 5% next year, you have zero equity. You are trapped in that house. If it drops 10%, you cannot sell unless you pay the bank to let you leave. The banks are watching these specific zip codes like hawks. And don't get me started on insurance costs in Florida and California. That is the silent killer making these homes unaffordable, even if prices drop. You might have great credit, but the bank might demand 20% down here. This is the reality of 2026. You can't just throw a dart at a map anymore. Real estate is hyper-local again. Know your specific street. And that brings us to part 4, the most important part, the banker's secret. I've been chatting with underwriters, the people who actually say yes or no, and they are tightening the screws. The risk appetite is gone. Here is exactly what they are looking for in 2026. First, debt-to-income ratio. They want this lower than ever. If you have a big car payment and credit card debt, you are denied. They know inflation has eaten your grocery budget, so old formulas don't work. Second, reserves. This is the big one people forget. They don't just want the down payment. They want a panic fund. They want to see 6 months of mortgage payments sitting in cash after you buy. Third, job stability. The gig economy is not their friend right now. Uber driving, freelancing, commission only. That is going to be tough. They want boring, steady, predictable W-2 income. The brutal truth is that banks are cherry-picking the perfect borrowers. In 2021, if you had a pulse, you got a loan. In 2026, you need a halo. They are protecting their balance sheets because they see the data we discussed. They know values aren't rising to bail out bad loans anymore. So, if you are planning to buy, you need to think like a banker. Don't ask, how much can I borrow? Prove I am zero risk to you. Show them the reserves. Show them the stability. Build a moat around your money. That is the only way to get the vault door to open in a frozen market. So, what is the bottom line here, friends? The 2026 housing market isn't necessarily a crash, but it is a grind. It's a stagnant, expensive, picky market designed to test your patience. JP Morgan says flat prices. Rates are stuck over 6%. The Sun Belt is cooling, and banks are locking the vault doors unless you have the golden key. My advice? Patience is your best asset right now. Cash is king. Liquidity is your lifeline. Fix your credit, pay down your debts, and get your DTI in order. And do not let FOMO drive you into a bad deal. The house you want will likely still be there next month. Ignore the propaganda that says, marry the house, date the rate. That is dangerous advice. Marry the monthly payment instead. I want to know what you are seeing in your town. Are prices dropping? Are houses sitting? Let me know in the comments below. I read every single one of them to keep a pulse on the market. If this video saved you from making a mistake, please hit that subscribe button. It helps the channel grow so I can keep bringing you the truth from the streets. Stay safe, stay liquid, and I'll see you in the next one.